Okay, so we've just had the monthly jobs data drop, and just to go through some of those big numbers once again, unemployment rate held steady at 3.9%, but we had a surprise number of jobs added to the economy, around 60,000 or so. 69,000 jobs were full-time, and we also said, as we were speaking just before, Nadine noted, drops in the underutilisation rate for labour that we have not seen for around 40 years. So a very tight labour market. But in global markets, of course, today, a lot of the tone has been set by what happened with the Fed, and stocks and bonds are rallying after the central bank delivered very few surprises and perhaps some consoling words to investors. But can we expect this to last? So to discuss this, I'm joined by Paul Ashworth from Cameron Harrison today. Thank you so much for joining us, especially on a day like today. What did you make from the Fed first and foremost? We may as well just start at your impressions of the meeting and what communications came out from it.
Hi, Carl. Yes, it's certainly a big day to join you. I think the key thing, Kyle, is that the Fed and its expectations for the cash rate had not been in alignment with the market. So if we go back to the March plot, of where the Fed members saw rates, they were seriously under where 3-month market futures were. Last night, that got realigned, and I think that's a very big thing for markets. And as you point out, it's indicating that the Fed understands the market conditions. Understands what it needs to do, and the fact that the markets and the Fed are somewhat now in alignment in terms of expectations is the beginning of a process, hopefully to moderate market volatility.
Is the situation as it stands now, given what's happened since Friday night with US CPI data, that okay, we can get the Fed making the right noises and consoling investors as to how they're going to approach things? Flexibility was a term, but simply if inflation data remains high, do we continue to see this kind of volatility? First in bond markets, which is remarkably high, but of course also by extension equities too, which are having a lot of trouble valuating or I suppose coming up with appropriate valuations in this market, given the interest rate outlook is so unsteady.
Sure. Well, I think the first part of that, Kyle, is the path of inflation and what that data looks like. The Fed, I think they're fairly assured that whether it's a 50 or a 75 basis point rate increase, as Powell has indicated in March of this year, they will do what it takes. And in the short term, they will deliver, with reference to that inflation data point, and that will get them, an extra, 1.5% to where they are today. I think that's fairly assured. That is what the markets are then taking, and I think it's really then at that point we're at this critical juncture. Do we have a Fed that's going to behave, in a bludgeoned, sharp manner like Paul Volcker in the late 70s, early 80s? Or will we have a Fed that's more nuanced at that point? And rather than taking it all the way up the plot curve to a 4% cash rate, will they have that pause at 2.75%, 3%, say? We don't have to cross that bridge yet. I think that, as I said, the Fed will deliver fairly automatically either 50 or 75 basis point rate increases over the next few monthly meetings. The question is whether they do take that pause and take in that data. I think the second point is in terms of inflation and where we see that in the US, we do see that moderating. One of the key things that we would note is the monetary conditions have been very accommodative, but also fiscal policy in the US has been very accommodative. Now that fiscal policy is now in a contractionary phase, and that will pass and is passing through the US economy at the moment. So I think the Fed will get to a point where it'll have the benefit of easing inflation. We did see, albeit modest, a modest reduction in the growth rate of core inflation last month, and I think we can expect to see that play out more over the course of the next 3 to 5 months, and that the Fed will probably get to a pause point at the end of this year, early next year.
We saw in the statement of economic projections that finally, I guess you could say, the Fed's acknowledging that it's going to have to slow growth and lift the unemployment rate to effectively bring down inflation. Is this kind of perhaps a tacit recognition that a soft landing is increasingly difficult and the economy will have to slow, even perhaps close to a recession, to be able to effectively manage inflation?
Well, it's a fine point as to what's a recession and what's not a recession, but I think that's exactly the case, and it's an interesting paradox, isn't it? Where the Fed and the Treasury, Janet Yellen, have been targeting wages growth and seeking wages growth. It's an interesting paradox that now to moderate inflation, and importantly inflation expectations, because it's the inflation expectations that are the increasingly the problem, that they're going to have to cause wages growth to come down from its current level. Our view is at a current level in the high 4s, early 5s, they're going to have to engineer an increase in the unemployment rate. And that's going to at least have to be an increase of around 1% if they're to break this build up in inflation expectations. So does that take you to recession? Well, I think it takes you to a consumer recession, which, as we know in the US, is it's 63% of the economy. So it's pretty important. From a corporate perspective, we're a little bit more sanguine there. We like the structure of the S&P 500, profitable constituents, and the significant service and industrial business in there. They've structured themselves very well over the course of the last 2 years. So even though longer term interest rates are now approaching 4%, that's not where their cost of funds are. So I don't know that you necessarily get a corporate recession, but certainly I think there's a big case for arguing for a consumer recession.
Okay. Are we going to be talking a lot more as well, considering that there's the demand side of things that's clearly driving the inflation story, but the supply side issues are highly variable and uncertain. It depends on what's happening in China, depends on what Putin wants to do with his crusade in Ukraine. Are we going to go back to talking about the misery index like we might have decades ago as a way of describing what is perhaps a really stagflationary economy where inflation is high and joblessness is picking up?
I think the Fed, and with the market's assessment, I think the stagflationary environment is probably overplayed. As I said, we are expecting inflation of itself to moderate through the remainder of 2022. If the Fed delivers on its I'll call it its 2022 plot, I think inflation can be brought under control. I think the you mentioned the misery index. I think what we do get is we do see the re-emergence of cycle, Kyle. For the last 30 years, we've been operating in this this secular stagnation environment, We've seen US 10-year bond rates now surpass their previous high from the last cycle. So I think the key thing that we have to start understanding and adapting to is that we're going to have a more cyclical economic environment, rather than the environment of 30 years of declining bond rates, and businesses and markets operating in that environment. They're going to operate in a more varied, as I said, cyclical interest rate environment.
Just tying that, and I've only got, unfortunately, one more question, or time permitting, one more question. Just tying what you were just saying back to effectively what's happening in bond markets at the moment. Do I take it from that you're of the opinion that we're seeing a structural shift in interest rates, which means higher bond rates or bond yields that do trend higher from here? And does that mean that bonds aren't yet an attractive proposition at these valuations now, and that we'll also continue to see the kind of high levels of bond market volatility we've come to get used to over the last 3 months? I do note the MOVE index is at levels that we're at March. We were seeing in March 2020, after all.
Look, certainly in the US, we're starting to to approach those higher levels, and with the Federal Reserve and presumably similar actions to occur by the Australian Reserve Bank. Certainly we are starting, I think, to test those higher levels. What could cause them to go higher is, of course, where the central banks don't meet on what look like agreed expectations at this point in time. Certainly, we're expecting, which is unique, in the last 10 years. We're expecting to see positive real yields in terms of those longer bond rates.